Professor and former chief economist at the International Monetary Fund, Kenneth Rogoff. Kenneth, it's always great to see you. I want to get your reaction yesterday, because I thought this was really interesting, right? The market was a little ahead of itself, thinking that things were going to be better than expected in 2023, that the Fed didn't have as much work to do. It had priced in that 0.5 point rate hike, but not necessarily some of the commentary that we heard from Jerome Powell. Your thoughts on whether or not we're going to enter recession and how deep you think it could be?
I think it's going to be hard to avoid at least a mild recession. The interest rates are probably going to stay up throughout 2023. The Fed is nowhere near having conquered inflation. That's one of the things everybody's depressed about. And I think they don't want to have to be dropping rates and then raise them again. And the markets are adjusting to this.
And this is the tipping point that I was waiting for. Not that I'm celebrating it in any way, but we've been talking about when the consumer's finally going to start to slow down. And that retail sales data indicated that that did happen in November, even though it appeared, at least from the headlines, that spending on Black Friday and Cyber Monday were pretty strong. Well, actually, the consumer spent, it ticked down 0.7%. The consumer is 2/3 of the U.S. economy. That's really substantial and really important. And I knew it was only going to be a matter of time before people had to start to pull back. Do you think that trend continues? Do you think this was a one-off?
I think that trend continues. And survey data, you never know whether to trust it or not, but it is true that consumer surveys are just awful. Everybody's consumer survey looks like that. It's not one particular methodology. And in the boardroom, there's similar mentality. And that's going to become reality. I mean, it's going to have people pulling back on consumption, and people are going to be cautious to hire workers, do new investment projects. And yet, there is still very high inflation. The wages went up quite a bit in the most recent evidence we have, and admittedly not as much as prices, but faster than people thought. That's going to feed back into prices, and interest rates are probably going to have to stay high for a while. And if I might say one further thing, there was this view that, well, when it's all over, interest rates will go back to that ultra low level that we saw just before this, before the pandemic and during the pandemic. I don't think so. I think that the decade before was a bit of an aberration, and they're going to end up higher, and they're just not going to come down all that much as the market seems to believe after inflation's gone.
I think you're right. And I just want to clarify that drop in November for retail sales. It was 0.6% for the viewers following at home. But I think you're right about interest rates. I don't think that we're going to see that again. That was a situation that we saw coming out of the Great Recession. And it was one of the remedies for it to try to build the economy back up. Having said that, one of the things that Jerome Powell has been talking about a lot is the labor market. And that is what concerns me. I think Americans are going to lose jobs next year. I think that's what he has broadcast to us, and that it has to happen as rates rise in order to get 7.1% inflation back down to 2%. And that's what I think most people aren't necessarily thinking about when they think about how 2023 is going to look.
I think that's absolutely right. It's hard to see how you're going to get inflation to come down on a sustained basis when, yes, the tech sector is firing workers, but a lot of sectors of the labor market are still red hot. I think the wage growth is still coming in future months. It's going to push up prices, and it's hard to see how you turn around that dynamic without having employment go up quite a bit. And I think that's what we're going to see. The question is when they might get cold feet and say, well, having 3.5% inflation is really not so bad, so we're going to take a few more years than we said. I think that's the question. Soft landing? No, I don't think there'll be a complete landing.
Thank you for saying that, because I don't think most people realize how difficult it is to engineer a soft landing. I imagine it's almost nearly impossible, especially because there is a lag between when you raise rates and the impact that it actually has. And so that's, I think, the tap dance that Jerome Powell is dealing with right now. But I want to go back to housing as well. The 30-year fixed loan right now, mortgage rate, according to Freddie Mac, is 6.3% and expected to continue to rise. That makes home ownership basically unaffordable for a lot of people, unless prices really plummet a lot. So not only will this send our labor market out of whack a little bit, it's really going to have an impact on the housing market.
Hard to see how it's not. The housing never moves as quickly as the stock market, but it does move. The interest rate, ultra low interest rates we had the decade previously were a huge driver of the housing market, a huge driver of stocks, Bitcoin, art, you name it. I don't think we're going back to the secular stagnation level of interest rates, as my colleague Larry Summers calls it. I think we're going to end up in a higher place. And that means there's adjustments to come in the housing market, and prices are going to have to come down so that more people can afford it. And so if you want to sell your house, you may have to bring the price down, even if people are resisting it at the moment.
But some people also look at their house as a piggy bank, right? They've looked at these inflated prices and thought, oh, I have X amount of wealth. And they're in for a little bit of a rude awakening. And I appreciate your insight on this, Kenneth. I think it's a hard conversation to have, and it's sobering news to give. But we always like to be upfront and honest with our viewers so they know what to expect. So I appreciate that. Thank you, sir.
Thank you.